In this video, we're going to talk about all things flexible spending accounts, everything you need to know. So let's begin the conversation with talking first about the types. So the different types are your healthcare FSA, your limited purpose FSA, and then also your dependent care FSA. With the healthcare FSA, this account is meant to be used for qualified medical, dental, and vision expenses. Now, this is an individual type account, so you can contribute up to $3,200 to a healthcare FSA. And it's also a salary deferral. So you're going to designate a percentage of your paycheck to go into the FSA. And this is done during the open enrollment period. So you generally can't change your contribution into this account until the next open enrollment period, unless you have some type of qualifying event, such as getting married or adding a dependent. With the healthcare FSA, if you choose to participate in this, you can't also contribute to an HSA or health savings account at the same time. With your limited purpose FSA, it's limited use. So this account is primarily meant to be used just for dental and vision expenses and potentially post-deductible medical expenses. With the limited purpose FSA, you have the same types of contribution limits, $3,200 for 2024. You're deferring a percentage of your salary, and this is done during open enrollment. Can't make any changes unless you have the type of qualifying event. But what's unique about the limited purpose FSA is you can also contribute to a health savings account at the same time. Now, with your dependent care FSA, this account is meant to be used for care expenses. So if you're a parent and you have dependents and you're working, but you can't care for them, you can contribute to a dependent care FSA and then use the money from that account for their care expenses. Now, the dependent has to be under the age of 13 or they can be disabled. With the dependent care FSA, you have higher contribution limits if you're married. So for single people, it's $2,500, but if you're married, you can put up to $5,000 into the dependent care FSA. Again, it's a percentage of your salary that you're deferring during your open enrollment, unless you have a type of qualifying event. So now that we've talked a little bit about the types, let's go into what the tax features are. Oh, the last thing to note about the dependent care FSA is you can also contribute to the HSA at the same time. As far as your tax features, money you put into the flexible spending accounts are pre-tax. So your contributions are actually going to save you money in taxes. They're going to reduce your wages on your W-2 tax form. So you'll see that in box 1. And then the money you take out of the flexible spending accounts to pay for the medical or dependent care expenses are a tax-free reimbursement of your money, as long as it's used for the medical expenses or the dependent care expenses. And then the other thing to note about this is there's no double dipping. So if you use the healthcare FSA for your medical expenses, then you can't also itemize your deductions on Schedule A and claim a deduction for those medical expenses. You can't double dip. And then similarly, you have to be cautious of using the dependent care FSA and then trying to claim the child and dependent care tax credit. Technically, you can reap the benefits of both a dependent care FSA and a child and dependent care tax credit if your care costs are high enough. And I give a couple of examples of this in the article that I wrote. If your care costs are too low, then you have the decision to make whether to take the dependent care FSA or claim the child and dependent care tax credit. And kind of the math shows if you're in a lower tax bracket, then the credit might be a better option. But if you're in a higher tax bracket, the deduction might be a better choice for you. So that's a little bit about the tax features. And now kind of let's compare the HSA versus the FSA. So with your health savings account, we're going to talk about the similarities and differences between that and your flexible spending account. So beginning with the similarities. So the purpose of the HSA and FSA are pretty similar in the fact that you're putting money into an account to be used for medical expenses, with the exception of the dependent care FSA. Also, they have similar tax features. So money contributed to an HSA and money contributed to an FSA, you're going to reduce your taxes by those contributions. Additionally, as long as you use the money within that account for qualified medical expenses, that's going to be a tax-free withdrawal. So similar in that aspect. And then finally, employers can contribute to both a health savings account and a flexible spending account. So they share that similarity as well. Now, as far as some of the differences, you have your high deductible health plan requirement. So in order to fund a health savings account, you need to be part of a high deductible health plan. So meet the minimum deductibles and maximum out-of-pocket limits. The contribution limits are also different. So you can put a different amount into an HSA that you can put into a FSA. And then there's also the investment component. So you can invest in HSA for long-term growth, but you generally don't invest flexible spending accounts, hence the difference, flexible spending account versus health savings account. So FSAs are meant to be spent while HSAs can be saved for the long term. And then the final difference, and one of the biggest things with flexible spending accounts, is the use it or lose it provision. What this means is if you don't use your FSA funds prior to the end of the year, you could lose those funds. So it's generally advised to fund the account to the extent of your anticipated medical or dependent care expenses. Now, some employers will offer you the ability to roll over some of your unused funds to the following tax year, but it's a very limited amount. I believe it's around $640 for tax year 2024. It's really important to understand this use it or lose it feature within the flexible spending accounts. HSAs don't have any use it or lose it requirement. Now, wrapping up with some considerations, we talked about it already, but whether to go HSA or FSA. Now, if you're planning on being part of the high deductible health plan, you find that's the best fit for your family, then HSAs tend to be more superior than FSAs, healthcare FSAs, as we talked about. But if a lower deductible health plan is a better fit for your family, and you can read more about my HSA article to understand the considerations with high deductible versus low deductible, then an FSA is still a great option to reap some tax benefits. And then we talked about the funding a little bit, but with FSAs, considering that use it or lose it provision, you want to try to fund the account to the extent of your anticipated medical or dependent care expenses. And I know this is very hard to try to project, but if you're young and healthy and you maybe only go to the doctor once a year for that annual physical, then may not be prudent to contribute that full $3,200 to the healthcare FSA. So something to keep in mind. And then the final thing I'll say is if you leave your employer. So if you were to leave your employer and you have FSA funds, then you might not be able to access those funds. So if you have a planned departure from your employer, consider using up your dependent care FSA or healthcare FSA funds before you lose out on them. Hopefully this was helpful. I did write an article that speaks a lot more to this topic, so click the top right of this video to access it, and thank you very much.